Hi everyone. So an important element of understanding monetary policy is that you understand the liquidity preference schedule. The liquidity preference schedule really just illustrates people's demand for liquid assets, which we can really take as cash to be the primary liquid asset, of course. It's a liquid asset because it is so easily converted into goods and services and so readily available for exchange. Okay, so let's just have a look at what we've got here. So the liquidity preference schedule reflects the demand for money, which is downward sloping because when interest rates are high, the opportunity cost of holding liquid assets or cash is high and vice versa. So therefore we can see that people's demand for money, their liquidity preference schedule, will look something like this. Okay, it's downward sloping, so there's an inverse relationship between the level of interest and the quantity of money that people actually choose to actually hold. And remember, we are talking about the most liquid asset, which is cash, of course. Okay, so if we start off at point A up here, then we can see that there's a very, very high interest rate corresponding to point A. Now at point A we can also see that there is a low quantity of money which is actually demanded. Now the reason for this, people don't want to hold lots of cash when interest rates are very high, because it's far, far better that they actually put that money into a savings account, that they put that money into buying government bonds and actually benefit from that high interest rate that's currently prevailing in the economy. Okay, so there's a real incentive to actually ensure that money is put away sensibly to gain that return, that high interest rate. Likewise, if we consider a scenario where we have a very low interest rate, we can see, well, the opportunity cost of actually holding lots of cash and having lots of readily available money, lots of readies, is very, very low. So people may well choose to actually hold quite a bit of cash at such times. Okay, now it's important to note that this liquidity preference schedule, or the demand for money, can shift. Okay, and yes, we'll come on to that in just a moment, but let's just understand why people actually need money, and so why there is always a certain amount of demand for cash. Well, firstly, it's about transactions demand. Okay, so that you have a demand for actually engaging in transactions to buy groceries on a weekly basis. So that's obviously highly important. There can be a precautionary demand within that component as well, and that precautionary demand could be people just wanting to have some cash just in case they need to actually prepare for any unforeseen circumstances perhaps. And our second main reason there is about asset demand. So if you want to actually buy assets, then you're of course going to need a good deal of liquid funds available. Okay, so you're going to need cash to be available, and therefore there is demand for money as a result of people's demand to actually buy assets. Okay, however, it's also worth noting that if you choose to buy a home, then of course you don't actually have a huge amount of liquid assets here, so your demand for pure money or cash is very, very low then, okay, once you've bought that house. Okay, right, so there's a number of factors that can shift this demand curve, and the first one that I've put down there is about income. So if people's incomes rise, well, it's likely to mean that they will hold more cash and they will engage in more day-to-day expenditure. Almost stands to reason, really, okay? Okay, secondly, we can see that when it comes to prices or inflation, if prices rise, then of course you're going to need more money to actually conduct those day-to-day expenditures that need to be undertaken, such as buying groceries, buying petrol, etc. Okay, and thirdly, what about technology? Well, technology and the fact that people are engaging far more in e-commerce activities, of course, actually reduces people's demand for liquid cash and perhaps actually encourages us to use far more in the way of credit cards and other banking services there. there. Okay, so yeah, there's factors that can shift this. Now it's also worth noting that on this diagram we can also include the money supply. Now in a given period the money supply is deemed to be fixed, and that means that it is considered to be perfectly inelastic. Okay, so if we put in the money supply here, denoted by MS, okay, and there we've got MS1. Okay, so that's our quantity of money that's actually supplied to the economy as a whole. Now we can see that this corresponds with an interest rate of R1. Okay, so R1 at MS1 here. Okay, now if the government the central bank and the Monetary Policy Committee decide to actually engage in quantitative easing or open market operations, as it's also known, then of course the money supply would actually shift to the right hand side, and we'd go from money supply 1 to money supply 2. Okay, so then we can see that the supply of money in the economy has grown, and people will actually choose to hold more cash in response to the lower interest rate that is available at such times. Okay, so we can see that there, but also this money supply would of course change if there is a change in the base rate. So if the base rate is reduced, then people have less of an incentive to actually save money, and therefore may start to actually consume money as a direct consequence of that. Okay. Secondly, the quantitative easing, well, we've covered that one. Okay. And thirdly, the reserve requirement ratio. So if the Monetary Policy Committee at the Bank of England actually bring down that reserve requirement, allowing banks to actually retain a smaller amount of capital for every loan they make, perhaps reducing it from say 15 to 10%, then of course the money supply in the economy would grow, and the interest rates prevailing in that economy would fall, of course. Okay, right, so there we go. That's a nice introduction to understanding this mechanism. We're going to have a look at the liquidity trap under this model, and that's an important evaluative means by which you can really tackle how effective monetary policy is likely to be. Okay, great stuff. Thanks a lot, guys.